Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Wednesday, July 29th, 2026. We're Elena and Marcus. This episode is brought to you by Bank Atlas, where the risk of every bank is quantified via proprietary grades and analysis. Learn more at bankatlas.com.
Let's get right into it.
Yeah, so imagine finding out your mortgage rate, your stock portfolio, and even the price of gas in your car were all being violently shaken by just 3 dissenting votes in a closed-door meeting.
Right, in Washington.
Exactly. That is the reality we are waking up to today. For you, the investor, we are tracking 4 critical themes emerging from our latest run of data.
And they are all highly correlated, dominoes falling in real time.
For sure. First, the Federal Reserve's hawkish hold has triggered a massive spike in the 30-year Treasury yield, pushing it to levels we haven't seen since 2007.
Which is significant.
Yeah. Second, we are monitoring a historic degrossing event by hedge funds. It is severely punishing the semiconductor sector and sending the Nasdaq into technical correction territory.
Right.
Third, Brent crude has surged past $90 a barrel on renewed geopolitical escalation, which complicates the entire inflation narrative.
Yeah, it locks those hawkish policy decisions firmly in place.
Exactly. And finally, we are seeing a stark post-Bell divergence in mega-cap tech earnings, specifically between Microsoft and Meta.
So let's unpack the biggest macro driver today. The Federal Reserve's FOMC decision and the resulting yield curve distortion.
Right. So the headline number is that the Fed held a federal funds rate steady at 3.50% to 3.75%.
Yeah, but the real story...
The one driving the market panic.
Exactly, is the internal division. The vote was 9-3.
With 3 highly hawkish dissents preferring an immediate 25 basis points hike.
Right, 3 dissents from regional presidents, Logan, Hammack, and Kashkari. This sends a definitive signal to the market.
Because historically, the Fed prefers to project total consensus, right?
Exactly. When you see 3 members break ranks to demand a hike, it tells you that patience with above-target inflation is just eroding rapidly inside that room.
So the central bank is fracturing on how to handle sticky inflation.
Right. And the bond market immediately priced in that uncertainty by aggressively selling off the long end of the curve.
And the resulting move across the curve was violent. Front-end Treasury yields found some immediate relief because there was no hike today.
Right. The 2-year yield actually fell 1.4 basis points to 4.275%.
But the long end of the curve completely broke out.
Yeah.
The 30-year yield surged 11.3 basis points to 5.205%.
And the 10-year yield rose 7.3 basis points to 4.681%.
Right. On the desk, this dynamic is known as a bear steepener. Let's apply our first principles rule here. For you listening at home, break down exactly what a bear steepener means mechanistically and, why it's so damaging.
Sure. Imagine a rubber band stretched between your 2 hands. Your left hand represents the short-term rates, like the 2-year yield. Your right hand represents the long-term rates, like the 30-year yield.
Got it.
So the Fed holding rates steady today essentially pins your left hand in place. There is immediate relief that borrowing costs didn't go up today.
Right.
But your right hand is being pulled aggressively upward by the market's long-term fear.
Because the market is pricing in higher for longer, or even higher still reality.
Exactly, because inflation is proving to be incredibly sticky. That stretching of the rubber band, the angle getting steeper and steeper, that is the bear steepener.
I see. And why does the market demand that higher yield on the long end specifically?
Think of it through the lens of taking out a 30-year mortgage.
Okay.
If a bank is lending you money for 3 decades, they are not worried about what the Fed does tomorrow.
Right. They're worried about 30 years from now.
Yeah. They are worried about inflation quietly eating away their returns over the next 3 decades. Because those 3 Fed dissents signal that inflation is not under control, the bank demands a much higher yield to compensate for that long-term risk.
They are raising the premium on time.
Right, they have to.
Which directly impacts the consumer and the investor by raising the discount rate on long-duration assets and driving up consumer borrowing costs across the board.
Understood. That explains exactly why our daily updates show MBA mortgage applications already falling 6.4% just this week.
The housing market is feeling the real-time physical effect of that long-end yield surge.
Yeah, the cost of financing long-term debt is becoming prohibitively expensive, which freezes housing inventory and stalls construction.
Which is a massive headwind for the broader economy.
Exactly.
Moving to today's data, we can trace the exact shockwave from those rising long-end yields directly into the violent repricing happening across equities.
Right.
The S&P 500 didn't just drop 1.52% to close at 7,316. It crashed right through a critical volatility trigger at 7,400.
And that triggered a massive wave of automated algorithmic selling.
Yeah. The Nasdaq 100 dropped 2.06%, officially entering correction territory. So that means it is down 11% from its record highs.
Right.
And industrials were the worst performing sector overall, down 3.19%, severely pressured by the reality of higher long-term borrowing costs.
But the index percentages only tell half the story. When we look beneath the surface at investor flows and positioning, our proprietary updates reveal the largest three-day degrossing event by hedge funds since November 2022.
Let us clarify the mechanics of what that actually looks like under the hood. Hedge funds added massive gross leverage in the first 5 months of the year to chase the tech rally.
Right.
And now they have abruptly unwound roughly 45% of it.
Yeah.
This is not just standard rotational selling where, a portfolio manager decides they prefer healthcare over technology.
Correct. It is forced liquidations and short covering. When a fund degrosses, they are simultaneously selling their long positions and buying back their short positions to drastically reduce their total market exposure or gross leverage.
And the reason this is happening right now points directly back to that 30-year Treasury yield.
Exactly. When long-term yields spike, the cost to borrow the capital these hedge funds use for leverage skyrockets.
The underlying math on their risk models instantly breaks.
Yeah, prime brokerages demand more collateral, forcing the funds to sell highly liquid, profitable positions all at once just to cover their loans.
And this unwind is heavily concentrated in the Magnificent Seven, where our data shows aggregate positioning has now collapsed to a one-year low.
Right. All of that speculative froth built up around AI and momentum in the spring is being rapidly cleansed from the market by this deleveraging.
Which brings us to the severe weakness in Asia. The selling pressure is a direct reflection of this global tech deleveraging. The Kospi plunged 6.0% today.
Wait, really? A 6% drop?
Yeah. And the Taiwan weighted index dropped 3.8%. But there's also a major structural overhang that hit the tape today, compounding the pain for semiconductors.
Right. The IPO.
Yeah, the Chinese memory chip maker CXMT just surged 466% on its $8.6 billion Shanghai debut.
And our desk data shows that historically, the 50 biggest Chinese IPOs return over 30% in their first 21 days.
Right, so CXMT now possesses a massive, highly liquid war chest.
Which creates a formidable competitive pricing threat for global memory.
Because we are moving from a market where you had 2 or 3 dominant, rational memory players tightly controlling supply to an environment with heavily capitalized, state-backed competition.
Right, and a state-backed entity does not always optimize for immediate shareholder profit. They optimize for market share.
Makes sense.
That threatens to compress the margins of the established semiconductor supply chain, amplifying the forced hedge fund selling we just discussed.
We also saw this tension play out in the immediate market reaction to mega-cap earnings post-bell. Microsoft jumped 3 to 4% after hours on a massive Azure cloud revenue beat of 43%.
Yeah.
Contrast that with Meta Platforms, which dropped 5% due to a Q3 revenue guide miss and significantly increased capital expenditure forecasts.
Right. Investors are actively questioning the return on invested capital for all of this AI infrastructure.
The market is currently punishing any company spending heavily on AI without demonstrating immediate proportionate revenue growth.
Microsoft is proving they can monetize their cloud infrastructure right now. Meta, conversely, is asking investors to trust a much longer, vastly more expensive capital expenditure cycle before the eventual payoff.
I have to push back a bit on the severe negativity around Meta's spending, though.
Okay, sure.
The way I view it, this is the fundamental difference between building a massive, highly expensive interstate highway versus finally collecting the tolls on a completed bridge.
I see.
Meta is pouring billions into laying down the asphalt, the physical data centers, the advanced GPUs, for an ecosystem that doesn't fully exist yet. That highway takes years to build and damages free cash flow in the near term. Microsoft, on the other hand, already has the toll booth set up with Azure. Enterprise clients are driving over the bridge today, and Microsoft is just collecting the fees.
Yeah, that makes sense.
The market is aggressively selling Meta because investors simply do not want to fund highway construction when they can buy a toll bridge that is already generating 43% revenue growth.
I see your point regarding the necessity of infrastructure, but that highway Meta is building could very well lead to a ghost town if consumer AI adoption doesn't match the scale of their investment.
Right. That is a big risk.
The tolerance for deferred gratification in the tech sector has entirely evaporated. When the risk-free rate, specifically that 30-year Treasury yield, spikes above 5.2%.
Capital becomes impatient.
Exactly. Investors are no longer willing to wait 5 years for an AI highway to become profitable when they can lock in high yields in fixed income today.
On that point, we have to shift from the inflation fears pressuring tech equities to the actual commodities driving those underlying inflation fears.
Right.
The energy sector was the sole equity gainer today, up 1.88%.
And the fundamental driver there is oil. Brent crude briefly crossed $90.55 per barrel today, while WTI sits at $84.58.
The primary catalyst is renewed Middle East hostilities and escalation involving Iran.
Right.
This is baking a heavy geopolitical risk premium into the price of crude, which directly threatens the Fed's entire inflation fight.
Yeah, if energy costs rise, it is not just more expensive to fill your gas tank.
Right, that cost passes through the entire supply chain.
Exactly, from plastics manufacturing to transportation logistics, eventually seeping into the core PCE inflation data, which is the Fed's preferred inflation metric.
Which perfectly validates those 3 hawkish dissents we discussed earlier.
Furthermore, we are seeing metals confirm this highly defensive posture. Gold is trading at $4,067 per ounce.
Yeah, and what is mechanically notable here is that the U.S. dollar index, the DXY, is remaining firm at 100.83.
Right. Typically, a strong dollar pressures gold because gold is priced in dollars.
Because if the dollar goes up, it usually takes fewer dollars to buy the same ounce of gold.
Correct. But gold is holding at historically elevated levels regardless of the dollar's strength.
This resilience implies a pure inflation and geopolitical hedge from institutional consensus, rather than a standard dollar inverse trade.
Right. Capital is actively seeking a store of value that is non-fiat, non-jurisdictional, and completely immune to central bank policy errors or Middle East supply shocks.
We are also tracking a compelling hard asset data point from today's data deck that bridges the gap between infrastructure and technology.
Yeah, this is a big one.
We are seeing a severe regional divergence in the U.S. power grid. PJM, the grid which covers the East Coast, is seeing day-ahead prices spike past $1,200 per megawatt hour due to severe supply constraints.
Right.
Meanwhile, ERCOT in Texas has seen prices plummet below $100 per megawatt hour.
That massive cost disparity between the PJM and ERCOT grids is completely rerouting physical infrastructure across the country.
Yeah, AI does not just live in the cloud. It lives in massive physical warehouses, packed with servers that consume the electricity equivalent of a small city.
Because AI data centers require massive, uninterrupted power loads just for baseline operation and cooling, development is migrating rapidly away from the constrained East Coast and moving down to Texas.
And that migration requires immense physical capital. You cannot just move a data center overnight.
No, for sure.
This is driving a highly specific infrastructure and utilities trade that will play out over the next decade. It heavily benefits Texas-based power providers and construction firms while highlighting the severe physical bottlenecks of the global AI rollout.
Indeed. We need to step back and connect all of these seemingly disparate asset classes.
Yeah.
We have a spiking 30-year Treasury yield, a 6% drop in the Kospi, and $90 oil. What do all these simultaneous moves suggest about the broader economic regime we are entering?
The market is beginning to price in a stagflationary environment. It is the only macroeconomic framework that neatly explains all of these data points occurring at the exact same time.
And the proof is in the macroeconomic revisions. Our internal strategists recently lowered their Q2 GDP growth forecast to a mere 1.8% annualized.
Right. That indicates significantly slowing economic growth.
Yet, as we just established, oil is surging past $90, and core PCE inflation, which strips out volatile food and energy prices, is stubbornly sitting at 3.4%.
Slowing growth paired with sticky inflation equals stagflation.
It is the absolute worst-case scenario for a central bank because they cannot cut rates to stimulate growth without reigniting inflation.
We have undergone a definitive regime shift. The first half of the year was dominated entirely by micro drivers. It was all about AI chip shortages, scaling laws, and momentum euphoria. Now macro forces are firmly in the driver's seat. Interest rates, Middle East conflicts, and central bank dissents are dictating asset prices across the board.
Yeah, the historic hedge fund degrossing we discussed isn't just a panic or a temporary technical glitch. It is a structural repricing to this new, tighter, macro-driven reality.
I want to leave you with a final provocative thought regarding the credit markets.
Sure.
While equities sold off hard today and the long end of the Treasury curve surged, high-yield bond ETFs, specifically HYG and JNK, which track riskier corporate debt, only dropped roughly 23 basis points.
They were remarkably insulated.
Exactly.
Yeah.
So consider this. Is the credit market dangerously complacent to the stagflationary risks we just outlined? Or is the equity market simply having a duration-driven tantrum?
That is the multi-trillion-dollar question. If equities and the bond market are correct about the slowing growth and sticky inflation, high-yield credit is severely mispriced.
Right. Those lower-tier companies will struggle to refinance their CCC and BB debt at these new higher rates.
Meaning credit is due for a violent widening of spreads as defaults rise.
To quickly recap today's core takeaways, the Federal Reserve's internal hawkish dissent spiked the long end of the yield curve to 2007 highs, reflecting deep fears of sticky inflation.
Yeah.
Hedge funds aggressively unwound leverage in response, driving a massive global semiconductor rout.
And $90 oil is threatening to lock in a stagflationary macro regime, shifting the market's focus entirely from AI euphoria to hard economic realities.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.